Good morning, good afternoon, good evening, folks. Michael Zuber, one rental at a time, back with the man, myth, the legend, Mr. Dan Bird. How you doing, sir?
Doing well. How are you?
I am good to be sitting
Aren't you
on cash.
glad you're in cash?
I am so happy I'm in cash. I'm so happy I'm in cash. Although I got to tell you, I'm thinking about buying some treasuries at 4% for the first time in my entire life.
So that says something.
It does. It does.
So, the way that you need to weigh the market and the way professionals do it is, what is my risk?
Yep.
Do I have more risk owning treasuries at 1% than I do buying stocks?
Mm-hmm.
Yeah, I'll probably buy stocks.
Exactly.
But as treasuries get to 3 and 4 and 5
and
higher,
6,
the risk then gets weighted more towards treasuries. Now,
absolutely.
What happens when that occurs is people sell all their stocks and they buy treasuries. So it's yet one more gust of wind that could push us over the edge.
Oh, I guarantee. Yeah. For me, the number's really 5.
Yeah.
Right. This gets to 5%. I'm like, well, I can do real estate at 9. I can take my savings over here, move it over there. I actually might pull again for most of my life. Let's be clear. I haven't had enough money to consider it. I'm lucky enough for the last couple of years to be sitting on some cash. It didn't matter when 1-year treasuries were 0.26. Who cares? Right. Now the 1 year is over 4. It's like, damn, I got to pay attention. But that's not the topic for this video. This video is leveraged ETFs.
Even the 3-month is getting attractive.
Yeah, like 3 1/4, I think, or something.
Yeah,
it's pretty crazy.
Right. Okay, let me share my screen and show my newsletter real quick. Anyone is interested, send me an email to breakpointtrading@gmail.com, and I'll send you last week's newsletter and then add you to the list. And if you want to stop getting it, just let me know. No problem. So what I want to talk about, and this is something that I talked about in the newsletter, I tried to cover it as much as I could, although the structure of the newsletter doesn't really allow me to go into as much detail as I would like to sometimes. Mm-hmm. I'm looking at other ways, other methods of delivering information that might be better, better to consume, and even more importantly, better to go back and reference later on. But I'm thinking about that now. I'll talk about that later once I figure it out. But what I thought I would do now is to talk a little bit more detail about leveraged ETFs. Mm-hmm. So people might have heard about leveraged ETFs, but they might not completely understand how they work. So leveraged ETFs is a security that amplifies the returns. If you get a traditional ETF, it typically tracks a security or a stock or an index on a 1-to-1 basis. But a leveraged ETF aims to give you a 2-to-1 or 3-to-1 ratio. So if you invest $100 in a regular ETF, let's call it an index ETF, let's call it triple Qs.
Sure.
And you want to get 2 times the money, you could go to the QLD. You can see the ETFs at the bottom down here. QLD gives you 2 times on the long side. So if the NASDAQ goes up 1%, you make 2%. And the TQQQ is 3 times. So if the NASDAQ goes up 1%, you make 3%.
Got it.
It's a great way to leverage your money. However, there's some downsides to think about as well. So while it's great to get 2-to-1 or 3-to-1, if you make the wrong decision and it goes the wrong way, you could also lose 2-to-1 or lose 3-to-1. Okay. These are not long-term trading vehicles.
No.
I want to repeat that, and I'll explain why here in a second. These are not vehicles for long-term trading. These are meant for a trader. They actually, I think, are a good vehicle to start testing trading. If you're thinking about doing it and you want to just put your foot in the water, understand technical analysis so you understand which direction the market is going. And you can do it with the NASDAQ, the S&P, and the Russell 2000. These are the ETFs down here for each of those. You can also do it with oil. You can do it with the VIX. You can do it with individual stocks, things like that. So these are leveraged ETFs, and they go both long and short. So if you think the market's going down like it is right now, you could do a SQQQ and get 3 times the inverse. So if the NASDAQ drops, you can get 3 times your money. Okay.
Yeah, I want to reiterate, this is trading, not investing.
This is trading, not investing. So leverage ETFs are usually rebalanced daily. So gains and losses will not track the same as unleveraged ETFs. This is why it's not a long-term investment. They rebalance every day. And the reason for that is because the way they get the 2X and the 3X is they use options and futures
of course,
as a way to spike the returns.
Got it.
And options expire. And if you hold options up until expiration, you get time decay. So the value of the options goes down the closer you get to the expiration date. And that's why leverage ETFs may not give you, even if you do a 2X one and you're right about the market, you still might not get 2X. I'm going to actually show you what that means here in a second.
Okay.
So the pros are leverage ETFs offer potential for significant gains, have a wide variety of securities to choose from, can make money when the market is declining using inverse leverage ETFs, which can be very attractive. If the market's going down, you can make money the market going down. Cons are leverage ETFs can lead to significant losses if you make the wrong decision. So 2X going up is also 2X going down. Leverage ETFs have higher fees and expense ratios. That doesn't really matter that much if you make sure you're not in it for the long term. And then leverage ETFs are not long-term investments. So I'm going to show you a few examples, and this will pretty much conclude this session.
Okay, thank you.
The first ones are some long examples. So this takes it from June. These are recent. This is the recent. So June until the rally we had in August.
Okay.
So if you bought the triple Q, which is just a single ETF, unleveraged, it would have been 8.1%. You would have made 8.1%
if you held it the whole time. Yeah. Okay.
Buying it here and selling it up here.
Got it. Okay.
All right. So over this time period, it went up. It closed higher than when you first got in.
Interesting.
Okay?
I see what you're doing.
8.1 is what you would have made through this period. You would think 2X would be 6.2, right? And 3X would be 24.3.
Right.
In an ideal world, you should have made 24.3% if you did the 3X.
Got it.
But let's look what actually happened. So the QLD, which is 2X leveraged, made 13.94, not 16.2.
Got it.
So you made less, 2.2%, 2.26% less than 2X. Because yes, it went up, but it also went down during this period. Remember, these rebalance every day. So they're rebalancing using options. So when it's going down, you're getting 2X down.
Right.
And it just so happened it ended higher over here. So yes, you made money. You made almost 14% instead of 8%, which is nice.
Yeah. So this makes perfect sense to me. The rebalancing every day means you don't get all of it. Does it ever work the other way where you actually make more than 2X, or is it always
Great
under?
question. Very astute of you. It's actually my next slide.
Ah, got it.
So,
I didn't realize I was a straight man.
Yeah, you didn't even know I was going to do this.
No idea.
So here's the 3X, right, was 17.66 versus what you hoped for 24%.
Right.
You actually got 6% less than the 3X.
Okay.
But that's because this went down and then went up. What if you got it right? What if you bought it and it went up the whole time?
Interesting. Okay.
So that's what this one looks like. So here you bought it down here and you sold it up here. So you got the direction right. It went up.
So it never broke below the bottom. Got it. Okay. Okay.
Right. So now we've got the triple Q unleveraged 20%. 2X should have been 41%.
Right.
And 3X should have been 61%. But 2X was actually 42%.
That makes perfect sense to me. Okay.
So now you're compounding your leverage.
Correct. Exactly.
Because you've got the direction right.
And it never
and
went
it continues
below.
going higher.
Got it. Got it.
All right. So now you're actually compounding. So the 2X, you're actually getting 1.85% more than 2X.
So you're
and the 3X, you're actually getting 6% more than the 3X.
So you're not only right for being directionally correct, but you're also right on the timing, right? You got the timing right versus the earlier chart. You didn't get the timing quite right. Got it. Got it.
That's right. And the key here with these leverage ETFs is number one, understanding where the market's going. Technical analysis really helps with that tremendously. If you can understand that and recognize where the market's going, and even if you just did it here and sold a week later, so it went up, and as soon as it started going down, you got out, right? You still would have made more than 2x.
Yeah, I got you.
Just for the short period right here.
Yeah.
And this was a longer period. This was 3 months basically.
Yeah.
But there's some things you could do. Like if you happen to buy it here when this started going up, you could say the first time its low is lower than the previous day's low, I'm getting out.
Got it.
All right. And that didn't happen until here.
Okay.
So you could have gone from here to here and you would have made more than 2x and more than 3x.
I got you. That makes
If you
sense.
want to look at the short side, same thing. So you can do this when the market's going down as well. These are all recent time frames, by the way. So this is after we hit the high in August, we started selling off. So in this case, we bought here at the beginning of August. We sold over here. So 3x would have been a 3.42 just on the unleveraged gain. I'm using the long one, but you could use the short one here. So you would have a 3.42 gain. The 2x would have been a 5.79% gain, which is still nice, right? Still nicer, better than 3.4, but not 2x. And then the 3x one would have been 7.84 versus the 10.2, which would have been 3x.
Got it.
So you still made a nice gain, but not as much. Now, if you get the direction correct all the way through, now you're compounding your leverage
direction
on the downside.
Yep.
So you're making 2x here. You're actually gaining an additional 3% by compounding.
Awesome.
And down here on the 3x version, you're making an additional 6% on compounding because you got the direction correct and you got out before it really started going back up.
This is awesome.
All right. So they're good vehicles. You can do it with the S&P, the Russell, the Dow, the triple Qs, the NASDAQ. You can do it with the VIX if you want to. You can do it with gold, all kinds of.
Yeah.
There are 2x and 3x. You can look them up on what they are. It is not for long-term trading. It's for short-term trading. You can tweak your gains if you get the direction right. Right?
Yep.
And you can tweak them pretty significantly.
Yeah.
Like down here, 43% gain in basically a month and a half.
Yeah, pretty cool. Well, Dan, again, this is all part of stuff for your newsletter. You do an amazing job with your weekly consistent content. You also add education. What is the newsletter if people wanted to get it?
Yes. breakpointtrading@gmail.com.
Awesome, buddy. Thank you very much. Next week's going to be
I'll
interesting.
send this past week's newsletter if anyone wants to sign up, and then you'll be on the list for the future ones. So this topic that we just talked about, I explained it with those same charts that I just showed you in the newsletter. So you'll get that if you sign up this week.
Very cool, Dan. Well, thank you for doing this. This is again going to be a week where I just sit on my hands. So thank you very much.
I think that's a really wise decision. We don't know what Powell's going to do. Just like last time when he talked to Jackson Hole.
Yeah.
The market crashed big time. If he goes to 100 points, the market's going to blow through the June low and we'll probably head it for 3,500 easily.
Yeah. Very cool, Dan. Well, thank you very much. We'll talk next Sunday.
All right. Take care.